Are we live, baby? All right, so we got Mr. Michael Noik in the house of Centura Finance. He's a mortgage broker. Welcome to the Freemium Podcast today. How you doing?
I'm good. Thanks, Curtis. Thanks for having me.
Yeah, we've been talking about this for a while. Full disclosure, Mike helped me out with my most recent mortgage. I had to renew my mortgage. I was with National Bank. He switched me over to TD, got me a good rate, and I was very happy, especially with the environment we're going through, the increase in interest rates, which was one of the reasons why I want to have you on the podcast today. It's a very, 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 very peculiar time. Rates are going up. You got the rates going up in the US. You got the rates going up in Canada. You got the rates basically going up all over the Western world. And a lot of people who have homes are wondering what they should be doing. Again, I just want to also preface this podcast today. This is not financial advice. This is basically, it's all going to be opinion based and stuff. And even though Michael is an expert, just, always consult a professional before you make any decisions. This is not investment advice in any way, shape, or form. It's a discussion. So just to make that clear before we get started. But thanks for coming on and tell me about yourself. How'd you get started being a mortgage broker?
Oh shit, we're going far back now, Curtis.
Yeah, we're doing it all, baby.
Yeah, well, first of all, thank you for having me.
You're welcome.
Appreciate that. Mortgage broker, mortgage specialist, 20 years now.
Okay.
Started in the banking world at the retail level, branch level, and just learned credit, understood it, liked it, and sort of morphed from there.
What did they teach you about credit at the beginning?
The bank credit guidelines are, it's almost, I don't want to call it a puzzle, but it's really all about how much income can support what your debt is and coverage and stuff like that. It sounds complicated, not nearly as complicated as they make it seem, but it's for sure in the world of credit, and at least and again, let me make it clear, residential mortgages in the grand scheme of real estate financing is sort of low-level stuff, right? Like, it's the most basic. It's not commercial. It's not business. But it's a great place to cut your teeth on learning how to navigate credit and what banks look for in terms of, I think they call it the 5 C's: credit, capacity, collateral, character. So these are some of the things they look at, and that's where I learned my credit and how to navigate that.
So basically, to assess a risk, I guess the way what we say in insurance is we call it a risk. So if we're looking at someone, let's say for example, their home insurance, or we're trying to insure a business, something like that, we'll go, oh, this is a really good risk, and we look at a lot of the same things as you guys look at. We'll check their credit, we'll check their character, or we refer to it as moral risk. And you can kind of tell at the beginning if someone's going to be a good moral risk or not. Usually after you've been doing it for a couple of years, within 2-3 minutes, you're going, okay, I think I know what I'm going to get here. But no, it's very interesting to always analyze risk and analyze credit risk from that type of standpoint. You've been doing it for 20 years, you just mentioned?
Yeah.
So I guess you like it.
I do. Very rewarding. And I don't mean necessarily financially. I mean, it's a rewarding thing to do, to be able to help somebody get into a house, or, sometimes unfortunately we deal with some difficult situations where, financial stress in the home, and if we're able to help them out, all the better.
Is that more your niche? Is your niche more kind of the cookie cutter? Okay, the person has a credit score over this and they make a salary that's in the top 5% of all people? Or is your target market more people that perhaps don't fit into that box, and you're basically there to try and find a solution that normal Canadian banking institutions won't give a mortgage to?
So, I think that's a great question. When I first started, cookie cutter was much more sort of what we saw. It wasn't everybody that had a mortgage 20, 30, 40 years ago. And I joke with clients, but, I recall my grandfather going into the bank 30, 40 years ago, and he'd put on his best suit and tie to go talk to the branch manager. And it was a thing, right? Like it was, I got to go see the branch manager. So, I got to get dressed up and talk to him. And
I got to look good.
Right.
Yeah.
Today, I mean, I've had clients sitting in the chair with their flip-flops and shorts, and mortgages become almost like a commodity.
Mm-hmm.
So your question about, is it cookie cutter? It's less cookie cutter today because so many people have mortgages. And as we know, in Canada, there's a lot of small business owners.
Mm-hmm.
People have multiple, streams of income, whether it's a couple of jobs or they have a small business here and then a job there. Or today, it's not even just, home ownership anymore. So many people have a home, maybe a duplex or a small investment property. So it's become really, I mean, I'd love to see the numbers. I don't know what they are, but what it was even 50 years ago, how many people owned a home versus today, how many people own a property. So
when you're saying that, so are you saying that I guess, because I'm not sure if I fully understand. You just mentioned a couple moments ago, mortgages, there weren't as many people, let's say 30, 40 years ago, that had a mortgage. So how are they purchasing houses? Were they just buying them cash? Was that more common, or there's just fewer homeowners around?
I think in those days, home ownership was just less prevalent, right? Like I think there was more renters than there were home owners. And today it's sort of like, it's one of those things. It's sort of like it's almost become like I don't want to call it a rite of passage, but it's sort of like, the right of home ownership, and everybody wants to own a home.
The American dream.
I guess
or
Canadian dream,
yeah.
or, so.
Get a home, get a home, you got the kids, you got a car, you get a pension for life after. And that's kind of,
it's amazing how many people own property today.
Yeah.
And so sort of, I guess it's a bit of a backwards way to answer your question. It was much more cookie cutter 20, 50, even 15 years ago. Today, it's become much more complicated. You still have your cookie cutter. It fits the box perfect. Thank you very much. Bonjour la visite.
Mm-hmm.
Whereas now you have situations where you got to explain the income to the bank, and it's they've got multiple properties, and some banks aren't very good with multiple properties or how they recognize some of the income from those properties. It's definitely the landscape is more complicated than ever. And so,
is this because of the institutions are getting more picky when it comes to giving out a loan, giving out a mortgage? Or is this, for example, regulation? Could it maybe be the CMHC, or just because it's a very regulated space that you're in, just like myself. You guys, I would argue, are even more regulated. You're probably more regulated than trading stocks. I mean, it was crazy. That was one of the things for me when I just renewed my mortgage. And I know it's not your fault. It's no one's fault. This is just the way the process is. I cannot stand paperwork. And one of the things, oh my God, just the paperwork, the sign this, sign that, send me this, what's this, verification here, verification there. It was I got frustrated with it. And sometimes I would come across, so Lee, if you're listening, I apologize. Sometimes in my emails, I would come across a little bit short, and I know it's not her fault. She's just doing her job, and this is just the way the process is. But I guess, so my question is, the banks, are they more picky because they chose themselves to be more picky, or is regulation forcing them to be more picky?
Well, I think we have to remember, the bank is a for-profit business.
Of course.
And one of their revenue streams, or one of the big revenue streams, is credit, lending money. So they certainly they don't want to be loose and take on a tremendous amount of risk, but they certainly want to be able, there's a balance, right, between too much risk or too little risk. If you're not lending enough, then you need to probably take on some more risk. If you're lending too much and you're too loose, then you may be taking on too much risk. So I think, and you make a great point, it is a highly regulated industry. Mm-hmm. You have the Office of Superintendent of Financial Institutions that sort of tells you, okay, well, you can't do this, and you have to do this, and you can only lend based on this, and these are the criteria. And what that's done is that's also opened the space for a lot of alternative lenders, which pushes people from a traditional bank or mortgage finance company with the cheapest rates to lenders that are a little more expensive, but are a little more flexible in how they underwrite their loans.
They have a broader appetite.
Absolutely. And they, they I don't want to say they charge for it. It's a little more expensive.
Yeah.
But there's a space for it. I think also if you read in the papers, I guess online now, right? No more papers.
Yeah.
But what's coming out is private lenders are booming now.
Yeah.
Because clients just no longer qualify as easily as they did certainly in the last 2 or 3 years. So it's definitely an interesting landscape. I think you said, what's going on today, the current state of the mortgage industry. The one word that has come to mind, and again, it's 20 years I'm doing this, it's not that we've never seen these rates before. These rates are not uncommon or unheard of. It's not like 5%. Wow.
Oh my God. Yeah.
It's the world, ask our parents.
Yeah.
They saw double digits.
Yeah.
And high double, 15, 16, not for a long time, but it was there.
Yeah.
But even up until, if we do the research, I guess I'm going back about 12, 15 years ago, the rates were about what they are today. What's unprecedented is how low we were and how quickly we went from really low to 5.
Yeah.
Not up until 18 months ago, you were getting sub 2 on a 5-year fixed.
Yeah.
Today you're at 5 and change.
Yeah.
And that's a big difference. And so the one word that's come to mind in the last few months is, I know maybe it's not a great fancy word, but the only word I can think of is weird. It's a weird time. The fact is that when the rates were really low, it was much easier to qualify. Because again, the way the banks look at it is your income versus your expenses. And so if your mortgage, which is the biggest debt that you're going to carry, is really cheap, then you don't need as much income to qualify.
You have more disposable income to do other things. And
correct. And fit the box.
Yeah.
So today, what took X amount 2 years ago to qualify, you got to make 25 to 30% more money today to qualify for the same amount, not 2 years later.
That's what I find. It's interesting, I guess, from a macro perspective. So yes, the rates went up. Yes, there's fewer home transactions going on right now. Have you guys seen a dip in activity at Centura Finance over the past year versus, let's say, 2 years ago? Are you guys doing fewer transactions?
We're definitely seeing less transactions, and mostly in the purchase space.
Same. Interestingly enough, people go insurance. Like everyone needs insurance. Same for us, because people. It's very interesting. I don't know why it's like this, but a lot of home sales and a lot of car sales too take place in the spring. So this is in Canada, in Montreal, around Montreal and Quebec, Ontario as well. Why is that? Who knows? Maybe it's finally warm outside. I'm going to go buy a house, and so for us, and it's not just KBD. A lot of other insurance brokers as well. April, May, June are chaos. It's just busy, but it's good for business, right? So we're selling a lot of policies, make a lot of money. And in the past, last year for sure, even us as well, way fewer transactions, way less activity. We're selling less policies, and it was the same thing for a lot of other people in our industry as well. So there's definitely, I don't think it's very cool and scary at the same time to see when there's fewer. The Canadian economy is very dependent on real estate.
Absolutely.
And it's kind of starts to spread into other sectors. So it's like insurance, you guys, banking, banks run the country. They do have a lot of influence in a lot of things. It's just kind of cool to see.
Well, general contractors, Home Depot,
all that
movers.
Stuff. Yeah.
I mean, there's just a tremendous amount of.
And like the boom over COVID, I mean, a lot of times because the value of their homes were going up by, 50, 60, 70, 40%, whatever it was. They were going up a lot. And a lot of people are just going out, getting a home equity line of credit, And then they go, hey, I got $150,000 sitting on the side here. I'm going to renovate the basement.
Yeah. Good luck finding a contractor.
Yeah. Contractors love it because they're going, who wouldn't?
Yeah, but they were slammed, eh?
Yes.
Like I tried calling a bricklayer to come do some brickwork.
Yeah.
And I called 3 of them. Not one showed up. Not one showed up for a quote. I mean, I never heard of such a thing,
One of my buddies, he's high up in a really big construction company here in Montreal. And they have an office in Toronto as well. Same thing. He's a general contractor. He was building his house. He had trouble getting contractors to build his damn house.
Good luck.
Yeah.
It was insane.
Yeah.
No, but so it's weird because now that's changed a lot. Yes. I have a lot of I'm sort of circling back to your question about, cookie cutter, not cookie cutter. I do deal with a lot of business owners, self-employed individuals, of which, many, general contractors, some of the trades guys, electricians, plumbers, carpenters, so on and so forth. And during COVID, they were slammed. They couldn't take on any more work. You're starting to see now where they're kind of like, I'm hearing a little bit where guys are like, oh, you know what? I had a deal. It was signed, ready to go. I'm supposed to, quote unquote, break ground, let's say in April, and they've postponed me. And it's not a one-off. I've heard it a few times where a couple of guys are like, it looks like I lost this deal, and people are just sort of, I think people are just sort of, hitting the sidelines for a little bit.
Do you think that's because people are in a little bit of financial pain right now, and perhaps they can't afford that project? They can't afford that basement renovation. They can't afford that kitchen renovation right now. Do you think that's part of the reason why maybe there's less work for these tradesmen to do?
I think so, for sure. I think the fear of inflation.
Yeah.
I mean, if you got some mouths to feed at home, it's got to be costing you a few $100s, if not $1,000 more a month.
Food inflation's nuts.
Insane.
Yeah.
Insane. I've got, healthy kids, thank God, everybody's good, but I got 3 mouths plus a wife and myself, and we're a 2-income family, but I mean, my kids like to eat fruits and vegetables. Well, 2 out of 3 like to eat fruits and vegetables. One likes Oreo cookies, but they went up in price too. So, but no, I think people, there's a little bit of, worry, especially if I have a mortgage coming due. Right, and your mortgage,
they have to renew.
Yeah, so if you got
which is why they should call you.
Well, please do. Well, at least for a second opinion. But look, you mentioned you brought up your own mortgage.
Yeah.
We don't have to get into numbers, but you must have seen a difference in what it cost you before to what it cost you today.
It was 4.99 with, I mean, it's pretty open. The numbers are always changing, but so the major financial institution TD is a 3-year 4.99, I think.
Yeah.
3-year fixed 4.99% interest. Has it gone up? This is what, a month ago, 2 months ago I signed?
So it creeped up a little bit.
A little, yeah.
Yeah, up until rate announcement this past Wednesday,
okay.
Which the Bank of Canada held their ground.
Yeah, I saw that.
And so I think the market has responded by lowering their expectation on long-term rates. So you took a fixed rate.
Yes.
And that's another interesting thing that's been going on. For so long, throughout my career, people would call you, and I'm sure you feel it too. It's sort of like they call you and say, well, what's your rate? And without giving you details on what they're asking, what they need, who they are, they're asking what the rate is. Mm-hmm. And I can tell you that 9 out of 10 people, when they say, or when they used to ask, what's your rate, what they were referring to was what your 5-year fixed rate was. Mm. Today, I don't think anybody's asking what the 5-year fixed rate is. Everybody's looking at short-term, 3-year, everybody's sort of prognosticating.
Yeah.
That long-term, the rates are going to come back down to 2. So I don't want to get locked into something too long. Plus, and at the shorter rates, the shorter terms are a little more expensive. So it's just a weird time. Never saw that before.
The reason why I took a 3-year fixed as opposed to a 5-year fixed, and again, this is just me, my logic was, if we look at the yield curve, the reverse yield curve, or what's it called again? Anyways, it basically
that's a good term. It sounds good.
Oversimplification for, I like to follow financial news and all that stuff. And the yield curve, long story short, is indicating, and it's not always correct, that the rates are going to come down in 3 to 4 years.
Right.
That's not a guarantee. Maybe they'll go up. Maybe we'll have 15% inflation next year and they're going to have no choice but to put the rates up. Who the hell knows? And this is always the kind of the crapshoot when it comes to predicting what the real estate market's going to do or predicting what the stock market's going to do. No one knows. So anyways, my logic was just, I'll take the 3-year. Okay, big deal. Let's say the rates don't go, let's say they stay stagnant in 3 years from now and I have to renew again for 3.99 or 4.99 or 5 or 5.5. I'll be okay.
Well, yeah, and you'll have been used to it. But yeah. See, what's interesting is, what was your term before that?
I took a 5-year fixed.
Right.
At 3 point something percent.
Right.
Yeah.
So that's my point, is that when you did that in, I guess, 2018, early 2018, that was sort of the norm. Everybody was looking at 5-year fixed or variable. It was one of the two.
Yeah. I have a question. Okay, so in Canada, the 5-year fixed, not so popular right now, but 2-3 years ago, like you said, was very popular. How come we don't have 30-year fixed rates like they do in the United States? Why is that?
I have no clue.
That'd be nice, though.
Yeah. Well, listen, we've got 7 and 10.
I didn't know that.
Yeah.
Really?
Yeah. You know
like
how many?
The big banks?
Yeah. You know how many? You know how many I've done of those?
How many?
1. No joke. And I don't think the guy was too happy.
What was the rate?
Oh, at the time I don't recall, but it was definitely. So I was with National Bank. My goodness, the rates must have been in the 4s, and he thought the rates were going to go up. So he took a 7-year.
Yeah.
And it was about 1% higher. But so that's insurance, is what he basically paid for. Right?
Yeah.
But now you're making me think, why don't we? So I think there's a key difference with the States and Canada, is that in the States, I think you can write off your interest, which in Canada you cannot. I think, I'm not 100%, but I'm pretty sure. But I think the other thing is when you break mortgages in the States, there's no consequence, right? Like, you just break your mortgage, pay it off, and switch if you need to. In Canada, if you take a term, whether it's 5-year, 2-year, 10-year, there's a penalty when you break your mortgage.
And they're big penalties.
And they can be substantial.
Yeah, they're big penalties.
Right.
Yeah.
And so that's a big issue, because if you take a fixed term now, 5-year at, call it 5.5.
Yeah.
And then the rates shoot, like they drop, your penalty is going to be pretty hefty.
Huh.
Like, I'll give here, perfect example is myself.
Yeah.
I guess it was already COVID, because it was January 2020. I had a mortgage rate of 254 fixed. By May of that, 5 months later, the rates dropped down. You could get a 5-year fixed at 1.5.
Jeez, that's crazy.
Okay, right. That's what I said. And I did my own mortgage, right?
Yeah.
So I call up TD at the time, and I say, okay, well, what's my penalty? And they're like, oh, well, okay, we'll do the calculation for you. $45,000. Dude, I almost shit myself. I might have had a little poop there. So I was like, well, hold on a second. Okay, so I'm going to save, 5, 6, 7,000 a year.
Yeah.
But I'm going to spend 45 to do that.
Yeah.
Made no sense. So I didn't pull the trigger. But imagine that because I was locked in. So what you see is, when you take a fixed rate and the rates drop and you want to take advantage of that, that's where your penalty becomes really expensive. So if you can imagine, if you take a 30-year term today, let's call it 7%, and all of a sudden the rates drop to 4 and you're stuck, that's going to be pretty painful. The problem is you can't time shit, and you just can't.
No, you can't. You have no idea what the market. That's the thing. You can't time the market. That's tip number 1 when they're teaching you anything about investing or your housing and all this. It just, my old man would always tell me too, for his house. He's like, obviously, buy a house. Yeah, it's great if it goes up in value, all the more better. But you always say, don't buy a house as an investment. Buy in it because you want to live there. You like the location. You want to, raise a family. Buy it to go live in it. Don't buy it to as an investment. And if it goes up, fantastic. But a lot of times it's gonna go down. He bought a couple homes. He bought a house. He bought 2 houses actually at the peak of the 2008 financial crisis down in Florida. Yeah. He bought them both cash, and they both got slashed in half the value, and he sold them.
Oh, and he sold them.
Yeah, he sold. Well, sorry, he kept one of them. He sold the other one. So, yeah,
is he renting it ever? Because I could.
No, they're off the books now.
Oh, they're off the books now. Okay,
okay.
Because I wouldn't mind a little South Florida, or even any Florida.
Yeah, it'd be nice. Okay, here. So now that we're talking about banking and basically all the lending from the Canadian financial institutions, you got TD, you got National Bank, you got RBC, CIBC, a couple other ones too. Where do you see, and Canada's favorite question, I was telling Mike this earlier, our favorite thing after hockey is to basically make real estate market predictions. There is clearly stress building in the system. We kind of touched on it a little bit before. You mentioned your tradesmen buddies who are saying, hey, yeah, it's not as much work as there was 2-3 years ago or during COVID. There's stress building up. People, it's expensive to live. It's expensive to go get groceries. People's car payments are going up.
Gas
is going up. There's definitely an inflationary period, and wages are not keeping up with the cost of living, the increase in the cost of living. What do you see happening in the market, in the real estate market?
Oh boy.
I know it's a loaded question.
Oh boy.
It's a loaded question.
Boy.
Because the rates are going up, but if we look at the data for the prices of the actual housing, it's not really budging. Well, which is interesting.
Well, I think okay, so hard to tell right now because we're just coming out of the slowest period of the what's traditionally the slowest period of the year, right? Mm-hmm. Like December, January, February, like you mentioned earlier, usually April, May, June is when people are buying homes and cars. And I'm not sure why a lot of people buy new cars right when they buy a new home, but that's another phenomenon. But so we're just getting out of the winter. Mm-hmm. It's actually been pretty decent the last
week. Very mild,
not bad. And it's going to be nice again, I think, the next week or so. So I think that's something I would keep an eye on because, again, December, January, February, traditionally slow months anyways. But what I find interesting, and I deal with I deal with a few realtors that refer me clients, and what they thought was what would be interesting to see is as we go into the spring market, what's going to happen with inventory.
Yes.
So I think these next 4, 6, 8 weeks are going to be interesting in terms of if there's a big influx of inventory, then I would imagine there'd be pressure on prices because there'd be so much supply. Then I read in the paper yesterday, I think it was a Financial Post, there's not that much inventory coming onto the market.
There's not.
Right. Because people are like, well, what am I going to do?
Yeah.
I'm going to sell my house, but I'm not, I got to buy something.
Yeah.
So am I changing, am I buying something more expensive? Am I down? So people are sort of staying put to see what happens. If that happens and there's no real inventory, well, then there won't be any pressure on, I'm not an economist, but I did take, Econ 101.
You have a, you work in the industry, you're going to have a feel for the market. You're going to, your boots on the ground. And that brings me to one of my next points. So you're saying that, so inventory, not going to go up. They just released, these are the banks, they just released, so this is CIBC. This is courtesy of Steve Saretsky. So I listened to their Loonie Hour podcast, a great podcast, very informative. And one of the things he was saying, so CIBC announced that 20% of their mortgages now are, in short, going into a reverse amortization situation, I guess we can call it. So basically what that means is with the new interest rates that they're charging, it's so expensive. The banks know that this particular person, or 20% of the mortgages, they can't afford more. So they're tapped out. They can't increase their monthly payments because the people are going to have to declare, they're basically going to be like, oh, I can't afford the house anymore. So, and the bank doesn't want that. So they're keeping their monthly payments the same, but these monthly payments aren't even covering the interest. So basically what it's doing is it's taking, for example, most mortgages are 25-year amortization period, correct?
25, 30.
25, 30, and it's going from 25 to 30 to 35.
Yeah.
So they're just increasing that amortization period. Now there's a whole slew of other factors that could, have its effect, but so I guess what I'm getting at, this is preventing for now, because the title of the article is Extend and Pretend. So
Yeah.
Steve Saretsky's basically saying his hypothesis is, look, this is fine for now, but eventually, what's the saying? The chickens need to come home to roost. Eventually, you got to pay off what you owe. So I guess it's kind of, again, who the hell knows what's going to happen with this market and everything that's going on. But I just, like the banks, there is stress in the financial system. And the banks know that they're kind of scrambling to kind of make sure that everyone can keep paying their payments. But what happens if interest rates go up to 7 or 8%? What happens? It's like, I don't know.
So yeah.
I don't know what's going to happen.
There's a few banks that do that. So what Steve was referring to,
yes,
and what we're talking about here is they don't, you're on a fixed payment. So, and it's based on what your rate was at the time.
Yeah.
So right now, not only are they not paying back capital, they're not covering enough interest.
Correct,
so they just keep tacking that on, and that what that essentially does is create a negative amortization situation. Yes. Okay. I think what'll happen is if that does create a big stress in the market, the government's going to have to step in and say, okay, well, we're going to have to extend amortizations, because, if you get a handful of situations where people are in trouble, they have to sell, that shouldn't move the needle. But 20% of a bank's book,
that's a lot.
That's a lot.
That's a lot.
And that's one bank.
Yeah.
Other banks that don't do that don't reset your, like Scotia, for example. Unfortunately, I have a mortgage on a property that's variable that I took a year and 3 months ago. Again, what's that saying? A lawyer or a client that's a lawyer representing himself, he has a fool for a client, or, I think I made that saying very long. But I mean, maybe I shouldn't be doing my own mortgages, but I think the point is that CIBC, TD, if I'm not mistaken, BMO, they also do that, where they don't reset your payment. Scotiabank, for example, as the rates go up,
they will reset.
They reset right away. So, I think what'll happen is the OSFI, the Office of Superintendent of Financial Institutions, they'll have to come in and say, because if I'm not mistaken, I think it's Japan, they have something like 99-year amortizations. Yeah, it's crazy. Yeah, because housing became so crazy and unaffordable that they just, it's like legacy. They just keep passing it on to their kids. And the truth is that, again, referring back to 30, 40 years ago, there was a time when, like, I recall a friend's parents, my mom, she didn't own a home. We were renters. I recall my friend's parents, when they paid off their mortgage, they took a cruise, as a celebratory, like this.
It's a big deal.
It was a big deal, right?
Yeah.
Hey, we paid off our mortgage. They were celebrating this. Today, I mean, no one's in a rush anymore to pay off a mortgage. It's like, whatever, I'll pay it off. I don't. We're seeing clients that are in their 70s and 80s taking mortgages today. Wow. If you look at reverse mortgages, I mean, we don't need to get into that whole discussion of what that is, but the fact is that reverse mortgages have exploded in Canada.
I'm curious, what is a reverse mortgage?
Okay, so reverse mortgage basically is it's meant for a much older demographic that's not ready to leave their house, and their cash flow is limited, right? Maybe they get they're certainly going to get a government pension, but maybe they get a previous employer pension or not, but their income is usually limited, but they're not ready to move out of their house. They've been there for 30, 40, 50 years. They want to, for all intents and purposes, they'd rather just be wheeled out.
There's an attachment. Yeah.
It's, it's where they've lived.
Yeah. It's probably raised a family there.
Raise a family there. Yeah. If the husband and wife are both alive, great. If one of them's passed on and the other one's like, this is where I lived with my husband or my wife or whatever, so they're not ready to move on. What it does is it allows you to be in the house without making any mortgage payments while you're there, similar to the negative amortization situation. So what they'll do is they'll lend you money let's call it $100,000 at 5%. They'll just keep adding the interest every year onto your mortgage so that when you do need to leave the home, whether by choice or not, they'll basically say, okay, well, it's been 10 years, so now you owe us $175,000. What this does is it takes the burden off the kids, right? Because at the end of the day, what's going to happen with this home? Likely going to be bequeathed, left to the children.
Yes.
Okay. Some kids will say, you know what? I don't care.
Before you go on, just a quick question. In most of these situations, does the elderly person, is the house paid off most of the time, or it's not paid off?
I've seen both cases.
Both? Okay.
Yeah, both cases, but often it's paid off or there's a small balance owing.
Okay.
It's
cool.
very, very small.
Yeah.
I mean, don't forget, if they've been in the house for 50 years, there's a good chance they paid $35,000 for this house.
Yeah.
And now it's worth,
$1 million or whatever
something
it is.
crazy like that. But it allows them to live in the home without having to make a mortgage payment. Yeah, they'll have to still cover maintenance and taxes and energy, heating, whatever, but they don't have to make a mortgage payment, which is going to be substantial. And what it allows, so basically the way I'd say it is this: if the parent doesn't have enough income to cover the cost of living in that home, someone's going to have to make up for it. And it's usually going to, the children, adult children, what do they call that? The crunch generation, or it's the generation that's got kids that they got to take care of and parents they got to take care of. They're the ones who are going to have to bear the burden of that financial burden of helping their parents out. I mean, most kids will do that for their parents, right? Mm. So instead of that, a lot of kids will say, you know what, Mom, Dad, this is your home. Use it. Live in the home. Be happy. Like, you guys take care of yourself. If there's money left over, great. If there's not, so be it. But it's your home. It's your retirement. Like, what am I going to do? Put you in a studio apartment, sell your house so that I can have some money? No. So if I don't know what the numbers are again, but I know for a fact that reverse mortgages have exploded not only in Canada, but in North America.
So in short, just to make sure that I'm understanding, and for the viewers, it's basically, look at it. So you got the house, it's almost like a piggy bank. So they want to have some disposable income. They can go back, get a reverse mortgage, and it's going to give them cash to go and do things that they want to do. Okay, got it.
If they need a caretaker, if they need to, listen, government pensions,
it's not a lot.
$1,500 a month.
Yeah, it's not going to get you much.
I mean, that's going to be canned food and whatever.
Yeah.
Energy bills.
Yeah.
Insurance is, you got home insurance and maintenance, shoveling the snow. I mean, so this is another product that's out there. Mortgages are no longer what they used to be, cookie cutter. Yeah. This is what you take a 1 year, 2 year, 3 year, 5 year. Thank you very much.
They keep coming up with new financial instruments the banks to keep lending money and to keep this party going. Is it going to come to an end one day? I think it will, but who the hell knows? Maybe it won't. The next step that I see happening, I don't see houses in particular in Canada and in major metropolitan cities in the US. So you got California, New York, specific places in the big metropolitan cities, Toronto, Vancouver. I always say this, I point to Joey because he's from Vancouver. It's like a brutal example of real estate. Unless you're a millionaire, you can't afford a home these days. Where I see this going is I think that, and it's already started in the US because people can't afford to buy the homes. Well, who's buying up the houses now? The banks, BlackRock, private equity. These are the guys starting to buy up homes. Very hush-hush. No one's really talking about it.
Absolutely.
And this creates a whole other, this is a social issue at this point, saying, hey, whoa, why the hell are banks owning homes now? And now we have people paying money to banks. And I was looking for it just before you got here in Canada. I don't know if it started yet, but if I'm not mistaken, I think it was either RBC or I might be mistaken. So don't quote me on this, but RBC or TD have kind of started to do the same thing through like the back door somewhere else to start buying up.
They're picking
houses.
Up homes.
Yeah.
Really?
Yes. This is what speculation. Okay?
No, fair enough.
I could be wrong. I know for a fact it's happening in the US.
I read 100%. I read something about that as well. Like we're talking about like the these huge big banks or hedge funds that are just picking up like neighborhoods almost.
Yeah, they're buying up the whole neighborhood. Yeah,
Unbelievable.
Yeah.
What are they going to do with that?
they're going to rent it out.
They're going to rent it out and create cash flow.
We're going back to a renter's nation. These are the people that can afford it, and then because the whole system is built on Canada's economy, a big part of the U.S.'s economy. I mean, Canada's economy, if it's not, it's the construction of, this is 2 years ago, I don't know what it is today, but the construction of real estate and real estate itself is like 50% of our economy. So if that thing, and who owns all the real estate? Well, the banks own all the real estate at the end of the day, right? So these people don't want their portfolio to crash. So they're going to do everything they can. They're going to throw everything in the kitchen sink to make sure that the market doesn't correct itself. It's like the saying, everyone wants affordable housing. They just don't want it to be their home, right? So it's, this, we have a crisis. There's definitely a housing crisis here in Canada. And like you just said, supply, there's a lot of red tape to build. So it's very difficult to build new homes. It's very expensive for the developers. Right now with interest rates, a lot of developers' activity has dropped a lot for new constructions.
And by the way, where are you going to build? Like Montreal's an island, eh?
Yeah.
I grew up in Laval.
Where are you going to build?
I grew up in Laval, and past Laval, there was not much going on.
Yeah.
Check out Mirabel, Saint Jerome, like it's exploded.
Yeah.
Saint Dorothy.
Yeah.
Unbelievable.
Yeah. They just keep going further and further and further. And those are the places that are affordable. But I mean, it'll be, I don't know. There's like no new construction coming in. They're bringing in, like, there's a lot of immigration coming in. And again, for the record, I'm not saying this is right or wrong. I don't care. But supply is staying the same. And more people are coming into the country. So it's a supply and demand thing. If you think about over the long term, okay, well, the real estate market's most likely going to go up. But then you have the other side, which is like, well, hold on. There's a lot of stress in the financial system. People are tapped out. People can't afford more payments. That should make the housing market crash. And then you got basically like, well, the banks aren't going to let it crash. They'll do everything they can. Maybe they'll come in and start buying up houses themselves. I would not be surprised one bit if Canadian banks started doing that.
I would
to protect their portfolio.
And I think what you said is they won't do it like as RBC or I mean, I don't need to name the bank, but
they'll buy another company.
It through somebody else, right? Yeah. Like, because it won't look so good.
Yeah. They'll come through the back door, they'll lobby, they'll get it passed, and basically, and like everyone's in on the this is the system, and like this is the point that we're at, and everyone's in on it. I'm not saying it's like corrupt or this or that. Who's to say any other system would be any better? A lot of people still have good lives and stuff like that. That's not what I'm saying. All I'm saying is this is where we're at, and it'll be very interesting times. I think we're at a tipping point now, and we're going to see what happens next. That's basically what I'm getting at.
Well, for sure, these next I'm curious to see what the spring and summer market bring. I think now what we saw during COVID, whereby, the house went up for sale, asking price $500,000, 16 people making offers, sells for $650,000. Those days are long gone. Mm-hmm. We are just not seeing that anymore. We've come back to where a person or people ask a certain price. There's a negotiation, and the price tends to come in a little bit lower than what the asking price was. That was sort of the norm. In the last 2-3 years, that flipped over, and the prices were going well above asking, but we're not seeing that anymore. Homes are sitting on the market for a lot longer. I mean, listen, just during the pandemic, I would get a client that'd call and say, hey, listen, the house went up on the market yesterday. I need to put in my offer today because there's 12 other people. And I'd have clients who literally made 15, 20 offers. Jeez. So you know what happens is the next time, I promise you, they will not lose that house for $25,000. Now, don't get me wrong. $25,000, $50,000, it's a lot of money.
Yeah.
But when someone's made 15 offers, and they're like, oh, it's only going to cost me $100 a month for the rest of my life. Well, they're going to do it. They're just going to bite the bullet. And so
why was that during the pandemic? Or why all of a sudden was there an explosion of offers and an explosion of activity?
Personal opinion?
Yeah.
Personal opinion?
Yeah.
You had a perfect storm. You had nowhere to spend your money. You couldn't go on. You didn't go on vacation. Most people didn't go on vacation.
No. Yeah.
You didn't really go out to restaurants, or
none of them are open.
Right. I mean, Uber. Maybe Uber started COVID. I don't know, but
Or Netflix.
Or Netflix, yeah. So you couldn't spend your money.
Theory. It was them, Pfizer, and Netflix that started COVID.
For sure. You couldn't spend your money.
Yeah.
The other thing was the government was printing money.
Yes.
Out of control.
Yeah.
Right? Like households of 4 people over the age of 16 that made minimum 5,000, whatever, that was $2,000 a head. So that's $8,000 a month of income. Not taxed at source. So you had that. And then if you're a business owner, there were all sorts of government subsidies. Personal opinion, totally necessary at the beginning, especially, what was it? That first week of March when everything got shut down, March 2020, everything got shut down. Stay home. Nobody can do anything. It was
stock market tanked.
It was it was a shit show.
Well, the whole world is just kind of like, okay, what the hell is going on? And I think everyone's they're like, stay put. We don't know what's going on right now.
Right. So you know what? Giving out money for the first month, 2, 3 to make sure that shit doesn't fall down, totally makes sense.
Mm-hmm.
You start creeping into month 4 and 5. Now you got to say, hold on a second. Let's just make sure what we're doing makes sense. Let's make sure that the money is getting into the hands for the people that really need it and not just going out. So in answer to your question, there was just a lot of money floating around, right? Like businesses became super profitable because you had subsidies, rent subsidies, wage subsidies. They had that 30,000, 60,000, just, forgivable, non-forgivable, 2,000. I mean, money was just there was programs everywhere. Mm-hmm. So you want to know a family of 4 getting $8,000, $1 million mortgage during the lowest rates, you could make those payments at under $4,000, $3,700, $3,800. That's for $1 million. So imagine a $500,000 mortgage, that's sub $2,000. Well, the government's giving you half of that or a quarter of that. So
perfect storm. Let's go buy some stuff.
Hey, let's go. Hey, buy.
You also had money was cheap. The cost of capital was very cheap, and then you had Tiff Macklem, who's the Tiff Macklem. I always mispronounce his name. He was saying when the pandemic hit, what's that? The famous quote he said: interest rates will be low for a very, very, very long time, because he wanted to spur activity in the economy. He wanted people to go borrow. He wanted people to go do stuff, buy houses. That's another reason too. And then they kind of backtracked that because now, he made it seem like rates were going to be that low for 5 years. And then they went ahead and they did this. I'm not saying they shouldn't have done this. There was one guy who's saying as a central banker, so he's shitting on the Fed. He's shitting on all of them, the Bank of Japan and all these guys. And they go, what, since you're so smart, what would you do if you were the head of the Bank of Canada? He goes, I'd resign.
Not a bad idea, but they might have been a little late. Right.
Yeah. And I think it's a tough position too, because it's very whenever they talk about central banks, the central bank is independent of the government. Give me a break. Obviously they're not. Also, you do want to cut them some slack. Sometimes I'm sure it's a very difficult position to be in. You're damned if you do. You're damned if you don't. You have political pressures. Now they're up Powell's ass right now because he keeps putting rates up, and the politicians are up his ass saying, hey, why are you doing this? This is really bad for the economy. And he's not trying to fuck people over. He's doing this because he thinks the alternative is worse. Having runaway inflation is going to be worse than having to go through the pain right now. His point is basically just, we're eventually going to have to go through this pain.
Yeah.
So, do you want to do it now, or do you want to have it? Inflation is the most hidden tax and a lot of people don't understand, and people are going through it right now. The next thing, I bet you anything. So it used to be 2% inflation that was good for us.
Yep.
They're probably going to try and massage it and say, it's 3 or 4%.
That's the band.
That's what you want now.
Yeah. Well, they're going to have to, because the 2 is going to be tough.
It's not going to happen.
I think it's going to be tough.
It's not going to happen. They just had job reports come out. They were
what were they this morning? Again?
I know for Canada and the U.S., they were very good. I think it was 300. I can pull that up. But they were good jobs numbers. And so when there's good jobs numbers, it means people are making money. There's a higher chance there's going to be just money sloshing around. If more people are buying stuff, I'm just explaining this for the viewers, more people are buying stuff, that's going to push prices up. Not good for inflation. And what they're trying to do is calm the economy down so that they can ring in inflation to bring it down.
Well, I was looking at the markets today, not that I'm so heavily invested, but the markets are taking a beating today. There's a bank.
Yeah. Want to talk about that? Silicon Valley Bank.
Oh, they shut them down.
That's as of today?
They Silicon Valley Bank is shut down by regulators. Yeah, shut down, which, I mean, if you look at the bank stocks today, they're all down about 2%. That's a bank stock, right? Like, especially in Canada.
It was the 12th largest bank in the U.S.
There you go.
Not sure if they're going to get a bailout. I won't be surprised if they do get a bailout.
Wow.
This is where I think that, I think this is kind of a topic we can discuss if you're interested in discussing it.
Sure.
What's your opinion on a bank like this getting bailed out? Should they get bailed out or should they not get bailed out?
Man. That's the damned if you do, damned if you don't.
Yeah.
Right? Like, I think back to 2008 and Lehman Brothers, they were like strung up. Sorry, guys, but they were the only ones, really. Everybody else got bailed out.
Mm-hmm.
You know what? I'm not smart enough to know. I mean, I don't know. The individual in me says, "Fuck them." You guys, like, live by the sword, die by the sword.
Yep.
But what happens if you do that? There's a lot of people that are going to get hurt if you don't bail them out. I think the problem is when we look at it, we're like, okay, but what, that fucking executive walked off with $10 million in bonuses and this, but you know what? There's a lot of other employees that didn't walk off with bonuses. They're going to have to pack their box and go home. And then what? So, and monies, how much monies are on deposit? And that maybe you can't get to your monies. And again, I'm not talking about the big corporate. I'm talking about just the individual that's like, again, not smart enough to answer that question. The truth is, if there's going to be a bunch of them that get in trouble, they're going to make one or two pay, and everybody else will get bailed out.
I just find, though, whenever this happens, number one, it's not, you call the U.S. and Canada a capitalist society, and this is not capitalism, because in a pure capitalist society, they would let that bank fail. That's the first part. And I think that when you don't let these institutions fail, you create a moral risk. And so these corporations, big banks, if they know that the government is always going to be behind them as a stop loss, and that it's a moral hazard, because they go, you know what? It's a win-win for me. If I make a shitty investment or I'm giving out loans to these companies that I know probably will never be able to pay me back, like they were doing in the 2008 financial crisis.
Yeah.
That led up to that. They go, I don't really care because the government's going to bail me out anyways. So I'll make all my money on my fees I'm going to collect now.
Yeah.
And then when it's time to pay the piper, I'm going to go cry to the regulators because they're all buddies with each other anyways.
Yeah.
And they're going to say, you can't do this. You have to bail us out. This is the system.
You have any idea what's going to happen if you don't?
Yes. But the thing is, it's not nearly, yes, there's going to be pain. But one guy said it best. I was listening to him on one of the podcasts I listen to all the time. He's like, guys, if one of these banks or a company or corporation, Bombardier, for example, they were under a lot of stress a couple of years ago as well. A few times, but nothing gets fixed, and that's a whole other debate. If you don't restructure, you have to restructure. And if you let these institutions go tits up, there's going to be a fire sale on the assets. It's not like they're going to poof disappear and it's all gone. There's going to be a fire sale on the assets. A bigger, healthier financial institution or company, corporation, whatever, is going to come in and buy it up 10 cents on the dollar.
Yep.
And they're going to restart. That's what's going to happen. And this is what capitalism is. It's not the nicest. It's not perfect. It's not the prettiest. But this is, a lot of people are upset with capitalism because there's a big gap between the rich and the poor and this and that. We can go on for days about this. But I don't know. I think these guys should not be bailed out. I think you let them go tits up, let them go bankrupt, and learn your lesson. I
think you said something really interesting. You said that moral hazard.
Yes.
Yeah. So they end up, and you're in insurance, so you understand risk, right? And
yeah.
And the risk that they take on knowing or feeling that there's a backstop. Hey, shit, like you said.
There's nothing to lose.
Hey, if we really owe a shit ton of money and the system's broken, well, someone's going to bail us out, because if not, we're just going to go and say, hey, listen, you taking a risk that this is going to this is the beginning of the end, the dominoes.
Yeah.
And I think that, if I'm not mistaken, I feel like Lehman Brothers had an opportunity to get bailed out. They just didn't play ball the way that the people wanted, like the government or whoever the powers that be.
I know they asked Warren Buffett. I know they asked, there was the head of the Treasury.
Yes.
He was the former
Hank
Haney. Was that not Hank Haney? Hank Paulson.
Paulson, yes.
Paulson,
tall, bald guy.
Yes.
Who also worked in the banks previous to that,
He was
by
the
the way.
CEO of Goldman Sachs.
There you go.
Yeah.
Goldman Sachs?
Goldman Sachs, I'm pretty sure.
And I'm pretty sure they got bailed out, no?
Goldman, I don't think they need to get bailed out. But
No?
Hank Paulson, Henry Paulson, there we go.
Hey.
Yeah, Henry M. Paulson. No, the thing that Goldman Sachs was doing was basically they were reselling all the mortgage-backed securities, and then they were selling them to people going, oh, these are AAA rated mortgage-backed securities. And then on the back end, they were shorting the same stocks that they were selling to other people. They were betting against them that they were going to go down because they knew they were a pile of shit. That's what Goldman Sachs was doing.
And then selling insurance to protect. I mean,
it was all over the place. And then these guys all get away with it, and then they get bailed out. And it's
what's
beyond,
an old boys club, eh?
Yes, it's beyond. And a lot of times from these financial institutions, what they'll end up doing is they'll go and then they'll work in the government after, and they'll go get a government job. So you hit the nail on the head. I think one of the big reasons why these guys never have to actually go through the pain or a bankruptcy is because they're all in cahoots with each other anyways. So, I mean, Bombardier, how many times are we going to bail Bombardier? The company should be bankrupt. They should not exist. They shouldn't. It's not a well-run company. Like, go bankrupt. Another company is going to come in, buy up all the assets, all the planes, whatever else there is, the buildings on it'll be a fire sale, 10 cents, 15 cents, 20 cents on the dollar. They'll start off from scratch again, and it'll be a well-run company. Because you know who pays, and a lot of people don't understand this either. Who pays when there's a bailout? The taxpayer. Why is the taxpayer paying for a bailout for a company like Bombardier that doesn't know they can't operate?
Well, I think I should call the department and tell them I'm having a hard time and I need a bailout. But I think it's an excellent point you make. Again, I'm not, because these guys go, like it's easy to go to the government and say, hey, listen, this is what it's going to look like if you don't do this. Mm-hmm. And also, I'm not going to, I don't want to suggest that there's some sort of collusion going on, but certainly as a regular Joe that doesn't understand high finance like that and doesn't have that connections, I look at it and think, well, hold on a second. The top guys are making a shit ton of money. Shit hits the fan. They get bailed out. And then within 2-3 years, they're getting their bonuses again. I got to tell you, as the regular Joe, kind of looks fishy. You know what I mean? Like, it doesn't look right.
I don't think they're trying to collude with each other on purpose, but I think when you're in that circle, so when you have people high up politically and people high up in the corporate institution world, they're naturally going to, speak to each other. They're probably going to be at the same events, the same fundraisers. And I think that's just kind of the way it goes. It's
no, I know, but the optics are
they're not good. I'm not defending it. I'm just saying I feel like this is just the natural way of the natural evolution of how these things go, and this is how over time empires fall. And I think it's just humans being humans. We're imperfect, and over time shit just breaks. I think that's just the way it is.
And then you got the government to fix it.
Yeah, yeah. How long have we been going at this for, Joey? Hour? 1 hour
already. Wow.
Here. So I want to talk more about mortgages. Let's stay here.
Yeah.
What your specialty is. I'm going out to refinance my mortgage. I'm a little stressed about what's going to go on. Can I afford to pay this? Interest rates are going up. What's some advice that you can give to people with you mentioned it earlier, there is definitely some stress in the system. People are stressed having to renew their mortgages coming up. Is there any advice that you can give to them to make this process a little bit easier for them?
The mortgage process.
They have to renew their mortgage. Let's just say that.
Well, listen.
What do you suggest?
First and foremost, if it's simply to renew and there's no restructuring, no need to access more funds, for sure, once your mortgage is coming due, it's an opportunity to review your finances. So that would include seeing, what kind of debts you're carrying. Are you carrying credit card debt? Are you carrying any loans? Are you carrying any line of credit debt? Any unsecured debts that's a little more expensive? And it's a good time to sort of step back, look at this and say, hey, do I want to consolidate some things? Because mortgages are a little less a lot less expensive than credit cards.
Of course.
So maybe it's a good time to look at that. And it's a good time to set a budget again. Because as things were really cheap in the last couple of years, you didn't, I don't want to suggest that it was easy for everybody, but certainly it was cheaper for everybody. Today, with the cost of food and the cost of gas and energy and interest and so on and so forth, probably a good time to sit back and review these things. So I think what I would want to do is, first of all, if I'm with a bank already or I have a mortgage and it's come due, I think I want to find out what the bank is offering. Hey, Mr. Bank, TD, Scotia, whatever the bank is. What are you offering me on a rate? Because when you get a renewal, you mentioned the pain of paperwork. You don't have to go through that paperwork again.
Yeah.
So that's number one. The thing I don't love about the banks, that's very different from mortgage brokers, is the banks are sitting on one side of the desk and you're on the other. And often they do the sort of like, okay, well, here's your rate. Well, but Mr. Bank, I looked online or I heard I can get a better rate. Oh, well, let me see what my manager can do and maybe we can. And you kind of don't get their best foot forward first. And I'm not a huge fan of that. As a broker, we're really on the same side of the desk as the client, and we're trying to find the best solution for them. And maybe it's not rate. Maybe it's a product that's a better thing, or a line of credit, or whatever it may be. So I think if your mortgage is coming due, what you do is you get the bank to see what they're offering on a renewal. You call a broker, find out, hey, is this a good offer, or can we review what the offer is? Can you help me look at what my finances are and should I be considering doing this or that, or can you suggest something? And a good mortgage broker is going to be able to do that. Maybe it is a traditional mortgage that you need. Maybe you need to set up with a line of credit and have access to funds for emergency or rainy day.
That was what you did with me. Like, so I had Nick Stefan on the one side, and the rate that National Bank was giving goes, I think you can get less than this. Introduced me to you. And you did a few things too, fixed it up, and I was like, "Oh, okay, cool. This is nice. This is great." I went with a major bank, TD. I was very happy with it at the end. Yeah. Like but it's not your fault if you're changing from one bank to another. The paperwork's the paperwork. There's no way around that, right? So you're open to discuss that a little bit?
I guess.
Sure. Yeah.
Well, so we set it up with a HELOC. Look, it's not for everybody.
Yeah.
But I'm certainly a believer that if I'm doing something and I'm opening up my file, then if there is room to add a HELOC or a line of credit, I should do it. Yeah. Because you never know if, when, God forbid, it's an emergency or an opportunity or whatever. It's nice to have access to money without having to scramble.
Yep.
So if and things happen. Times get tough, times get lean. I think you talk with your bank, you talk with a broker, and if it's a good time to review. It's sort of like what is it with fire detectors? They say it's twice a year you're supposed to check the batteries, that.
Every 6 months.
When you change the clocks, I think actually.
I didn't know
which is this weekend, by the way. I can't believe we have to change.
Is it already?
Yeah, this Sunday.
Spring
forward.
Yeah, fall back.
So it's going to be light out till like 7.
I love that.
Nice. Except the morning's going to be a little dark. But
that's okay.
When your mortgage comes due, a real good time to review that and talk to a professional, whether it's a banker, whether it's a mortgage broker, someone that can really give you some guidance. And like talking with myself, it's free. I'm not charging you to sit and have a phone call with me. We can talk for half an hour, and say, hey, this, you know what? And often I'll say, hey, Mr. Client, Mrs. Client, you're best to just renew where you're at. Just they're giving you a good offer. You're not looking for anything else. There's nothing else that we can do. Just renew. Or if things have changed in their financial situation, might be easier to renew. But maybe it's not. That's another thing. With the rates, how they've changed, qualifying to transfer is not so easy always. Sometimes you won't fit anymore.
Well, that ever happened will that ever happen where the bank will? So let's say I have a 5-year fixed rate. So let's say I got a mortgage 5 years ago. Let's take my situation.
Yep.
I had to renew, so I hit the 5-year mark.
Yep.
And let's say when I got my mortgage 5 years ago, I was really tapped out. Like, hey, I could not afford a higher payment. The stress test was up, Curtis. And again, this is hypothetical scenario. You can't afford more than this. And then we approach this period now. Interest rates are more expensive. Could they say, hey, Curtis, we're not renewing your mortgage. You got to go get a mortgage somewhere else?
Unlikely.
Unlikely? Okay.
The only time I've seen them not renew a mortgage is if the client wasn't very good at honoring payments, or if there was some sort of monkey business or something where they felt there was
something fishy
in the file to begin with. They won't send you packing midterm, but I've seen it rarely. But I've seen it where they send them a letter 6 months in advance and say, hey, listen, be prepared. We're not renewing you. But that doesn't happen. It's rare. The other thing is when you do renew with your bank, they don't put you through the process again. They don't check your credit. They don't ask for employment. But that's only if you're renewing. So you got to maintain the amortization that's left. You can't ask for $1 more. The minute you want to make any change to your mortgage, whether it's increase in money, increase the amortization, change a borrower because there's a divorce or there's a situation where, 2 people own a house and one is moving out or whatever, the minute you have to open that file, now you've got to go through the process, whether it's with the current institution or not. So if you want to add a line of credit, it's as though you're starting a whole new file. So all the documentation, employment, so on and so forth. Yeah.
Very cool.
Yeah.
Do you ever think one day that we'll have the Canadian system will allow other financial institutions to come in?
Probably not. I mean, there's a lot more banks than we know of.
Yeah. So there's Desjardins. You can get a mortgage. Desjardins,
but that's a credit union.
But you can get a mortgage with them, right?
Yeah, absolutely.
Okay.
Absolutely. But you also have what's called mortgage finance company. They go by a few terms: mortgage finance company or virtual lender. Guys like MCAP, First National, CMLS, Merix. These are strictly mortgage companies.
That's all they do.
Yeah. They're no brick and mortar. Everything's, online, great interface.
And are the rates that they charge, typically speaking, more expensive than the big banks, the big Canadian banks, or is it the same rates as what you'll get from a regular bank like TD?
That's a great question. Their niche, what they're really good at is doing insured mortgages. So when someone's buying a property and putting less than 20% down or transferring from one institution to them, they often have the cheapest rates. The other advantage with them is their penalties, if you do break your mortgage, is much cheaper than a bank. So listen, there's space for them. There is room for them.
So why would someone, I'll speak for myself. When I was renewing with you and we were shopping, before we had TD, it was with, I don't even
MCAP.
remember, that was with MCAP?
Yeah.
And then you said, I found it with TD. I was happy that number one, it's my banking, but I was happy that it was with a major financial institution. I guess there's just a brand associated with that. Why are people more, what I'm getting at is if it's the same rate, or let's say MCAP's going to be less expensive than a major financial institution, how come more people don't go get mortgages from these places?
So some people are uncomfortable.
Yeah.
There is a bit of a stigma, and I think that's changing.
I was like that too.
Okay, well, there you go.
But I thought about it myself in my head. I went, Curtis, this is not rational. This is a highly regulated environment.
Well, by the way, sorry for interrupting, but don't forget, they're lending you money. It's not like you're giving them your money.
Yeah, exactly.
So like if they go bankrupt, it's
not a big deal.
It's not like, I lost my money. No, wait a second, I owe you some money.
Yeah.
They'll figure it out.
Yeah.
And let's be clear, these mortgage finance companies or virtual lenders, they're all funded by big banks and pensions. Like these are not small players. They're huge. First National is huge. It's a public company that's owned by one of the richest, or was started by one of the richest men in Canada.
I didn't know that.
Yeah.
What's his name?
Smith, I want to say.
Okay.
Sounds like...
it's going to bother me now because I think I know.
First National, and he owns like 3 or 4. He's buying up Home Capital now.
First National founder. It's going good. Stephen Smith.
Stephen Smith, not Stephen A. He's the basketball guy.
We got in 1988 2 young Canadian entrepreneurs, Stephen Smith and Mortages, Tawse, T-A-W-S-E. I don't know how to pronounce that. Founded First National Financial Corporation.
They're huge.
Cool.
Are they public? Pretty sure there must be a ticker.
Let's go. First ticker. Yep.
Yeah.
Stock's down today.
Oh.
2.27%.
Well, banks are down almost 3. So
TD's down 1.19. Home Capital Group 0.5%. CIBC almost 2. Bank of Montreal 2.41.
There you go. Yeah, taking a beating, and that's rare for banks to go down like that.
Yeah.
That's all. Yeah. This is all fallout. Well, I don't know if it's all fallout, but I read that it's a lot of fallout from that Silicon Valley bank.
Bank.
Yeah, there's some worry.
Well, what was cool about that bank was, well, not cool. It sucks what's going on. Because they were the bank for startups in Silicon Valley. And if you think about startups, most startups fail. So is anyone really surprised that these guys are about to go tits up when you're lending money to startups where, if you look at the data, have an over 50%, I think it's closer to 75% failure rate. I mean, what do you think is going to happen?
Yeah, I guess, right? But what happens with the ones that succeed?
Well, they make a lot of money. But this is why in Silicon Valley, a lot of times they're not going to give you a loan. They're going to say, I'll give you money. I want 20% of your company.
Yeah.
I want equity in the business. You know? So, and even at that, still most of the companies fail.
But it's funny. And I was reading in the same article, they were talking about how so many of these startups don't even get to the next stage because they just get bought out, right? Like the minute,
if it's a good idea,
the minute a Google or Meta or
Amazon,
the minute they think that there's something there, or that they can, they'll buy it up right away and
Apple,
make the 2, 3, 4, 8 people very wealthy.
Yeah,
and then.
Well, we were talking about this last week. So YouTube started in, I don't remember already. It was around 2005. Was it 2005, Joe? Yeah, started in 2005, and they sold to Google. It was a year later, I think, right? Yeah, they sold a year later. So a company, a year old, sold to Google for $1 billion.
$1 billion.
After 1 year.
$1 billion.
$1 billion with a B.
Ooh.
1.5. Excuse me.
Yes,
1.5 bill.
That's a big difference. That 0.5 can make, I'll take the 0.5.
What would you, okay, let's say hypothetical scenario. So you rewind 20 years, okay?
Pardon me?
Go back 20 years.
Yeah.
So you have, okay, you can take the route of being a mortgage broker, or you can take the route of being a tech entrepreneur. You take the tech entrepreneur route. You come up with the business, and Apple comes up to you and says, Michael, I want to buy your business for, let's say, $50 million. This 20 years ago, $50 million. But you know in your heart, and you're damn good at your job, and you're 99% sure that you just discovered something, and you're 99% sure that in 20 years from now, the company's going to be worth $10 billion. Would you sell for the 50 mil?
Wow, that's a tough question. Shit. There is a good chance. I cash in my chips.
Okay. It's not 50 mil. It's 100 mil. We'll change the scenario.
No, I'm saying at 50, I'm cash.
At 50, you'd cash in?
I'm thinking I might cash in. I figured 50 mil, I'm good for the rest of my life.
Yeah.
But that's a tough question, you know? And not only that, some people might say, look, I'm not going to sell to an Apple. Like, why do I want to, just feed the monster? But I'd like to think that I'm, above that, but I'm not. 50 mil is 50 mil. 20 years ago.
Yeah. I think there's 2 scenarios though, because there's this one guy he started a company called diapers.com, and then he started another company.
Diapers.com. That doesn't sound like a high tech.
But it was a retail store. So Amazon was there to basically, they were up his ass to purchase him.
Up his ass at diapers.com.
pun intended, yeah. And but they strong-armed him. They came in and said, if you don't sell to us, they go, we're being nice to you right now. You don't sell to us right now because we're bigger than you. We can undercut you, and we don't have to operate at a profit for the next 10 years. We'll just undercut you, so you don't really have it. Because that's what Amazon does. They'll go in and say, we want your business. We're being nice. We're going to give you 50 mil or 100 mil, whatever the offer is. And if the person says no, they go, okay, we'll just put you out of business. And they put you out of business by running at a loss. And he said they came to him, put a gun to his head. And he's like, I didn't have a choice. So I think there's a difference between the point I'm trying to get to. I think there's a difference between people, founders who sell at that going, you know what, this business isn't going to be around for that much longer anyways. There's too much competition in the air, in the environment, versus another company like when Facebook just started. I think Mark Zuckerberg, because Yahoo wanted to buy Mark Zuckerberg 2 or 3 years into them starting. And Zuckerberg's like, you know what, I think I got something here that no other company understands, because they were building a new way of life almost.
Yeah.
It was like an online identity that they were building. Facebook has how many users does Facebook have now? It's over 2. Might be like 4 billion. It's crazy. It's something
like
nuts.
half the world.
It's something nuts.
Yeah, but you make a good point, because
1.5 billion active users.
1.5
It's insane.
billion. And it's what, 7 billion on the planet? Something like
or
that?
8 billion. Imagine having 1.5 billion customers.
That's 20 something percent. That's crazy. And by the way, but if I'm the diapers.com guy,
yeah,
I'm thinking the only thing I have right now is the name diapers.com, because if I'm just selling diapers or whatever, like that's not really technology, right? That's not. He didn't,
anyone can come in and do that.
He didn't invent anything. He just found a way, like a catchy name to sell something.
He was just very good logistically. He was good at the logistics side of it. He bought the URL. He bought the domain name diapers.com. It was a funny story about it, actually.
How much did he pay for that?
I want to say, it wasn't cheap. I want to say like 50 grand or something. He paid like, this is 20 years ago.
Right.
It wasn't cheap, but
margins on diapers got to be pretty good though.
No, they're horrible. Actually, they're lost leaders. But this is why it was a whole story. It was a podcast I listened to. I thought
it's a loss leader.
Diapers, eggs, milk, things that everybody needs are lost leaders. So Costco, if you go to Costco to get diapers, I guarantee you, number one, it's going to be all the way at the back of the store.
Yeah.
And number two, they're not going to make any money on it. In fact, they're going to lose money on it. But because they
want
want
to fill your cart on the way to the back or on the way back.
Exactly. And that's why everyone was saying for diapers.com, like, this isn't going to work because it's not a physical location. So why would, if you want to go buy diapers, you're just going to buy diapers. And he's like, no, I'm going to make the sexiest website, and they're going to buy shit, the same concept, but online. So on the way out, it's just pop-ups, buy this, this is on special. And it worked. It worked well.
Oh yeah, he did well.
He did very well. He sold it for millions of dollars he reluctantly sold to Amazon for millions of dollars. And that's kind of.
Well, there's stuff like, the contact lenses. It's stuff that you don't necessarily need to go to a store to pick up, right? Like,
yeah.
So going back to mortgages, it's not something you can just go online and do. There's got to be, unless it's cookie cutter. If it's real cookie cutter, that's easy, right? Like, you don't really need to interact with anybody. Mm-hmm. But that is no longer the case, right? Documentation. When you're a business owner, the documentation for a business owner is very different than the documentation for an employee of Bombardier.
Yeah.
So, and if there's anything.
Well, that was interesting for MCAP when we were going through the process. Maybe it was a different institution for my mortgage, and they wanted to see the books of KBD.
Yeah.
And I'm like, what?
Yeah. Look, and I don't want to single out MCAP because they're good folks. They're all the banks that we deal with are good folks. I want to make that clear. But often they ask for things, and it's not because they are asking for it. It's either a guideline or a policy. And I think, look, I happen to have a finance degree, and I happen to have taken accounting, but I'm going back 25 years ago. But I'm not very good at reading financial statements. I could look at the bottom and say, oh, look, it's in brackets or it's not, right?
Yeah.
But there's a whole bunch of line items in there that if I strip out or add back depreciation or whatever, it changes the whole thing.
Yeah.
So, we talk about inflation and grocery stores. They're claiming profits are through the roof, but it's not because of they're doing operational stuff. And well, I bet you if you read a financial statement from a grocery store, there's all sorts of stuff that's intertwined and mingled in there that can make it look better or worse, however you want to make it look.
Yeah,
so,
to a point, but you're absolutely right. I mean, right now, and there is a lot of people are saying that. I haven't looked too much into it, and I'm not an expert. Neither of us are experts on this, but it's very easy to manipulate the numbers to make it look, without being fraudulent, to make it look sexier than it actually is.
Absolutely.
And a lot of the banks are doing that. And especially right now in the stock market, like markets want profits. They don't really care about growth right now. The whole system wants profits. And so these big companies know that. They're, I don't want to say cooking the books, but they're exaggerating a little bit here and there to make it look like their numbers are better.
Well, it's accounting principles, right? So if you're allowed to do certain things.
Yeah. I had a girl, sorry to interrupt you.
Yeah, go ahead.
Quick little tangent. She worked at a big major firm as a Ernst & Young, one of the big guys, and her boss came up to her it was an audit on one of a big company, and said, it wasn't fraudulent, but said, she's like, well, I'm having issues getting this number to look like this number because the client basically said, this is what I want.
Right.
And the boss to this junior accountant said, I don't care, make it work.
Nice.
To kind of like.
Okay.
Yeah.
So they're starting from the bottom up.
More or less. Yeah.
Well, no, but that's true. It's just numbers, right? Like inventory, depreciate. I mean, I'm throwing items out there that I don't know how to read financial statements that well. So when a bank asks for them, I'm reluctant. First of all, now, besides the fact that if it's a sole owner, incorporated but sole owner, fine. But what if there's partners? I'm not sure if my partner came to me and said, hey, I'm doing my personal mortgage and the TD, MCAP, or whoever is asking for the company financials. I don't know how comfortable I am sharing that. Number one. Number two, look, the fact is that the way the banks work for self-employed individuals, whether they are registered or incorporated, they ask for 2 years tax returns to use to be able to determine what that person's income is. What's difficult, especially in the Canadian tax system, is people are always trying to find ways to minimize their tax burden, right?
Of course.
Okay.
Yeah.
So, maybe I drive a company car. Maybe I don't take as much money as I need to take because I don't need to declare more income. I have just enough to live and the rest I leave in the company. But I could afford a bigger mortgage. So this is where a guy like myself or a good mortgage broker comes in and is able to navigate that and say, hey, Mr. Bank, Mrs. Bank, look at this, but understand that, look, perfect example, the medical professionals, doctors are allowed to be incorporated. The fact is a doctor, even a general GP, probably makes about $300,000, $350,000 a year. Specialist, $500,000 a year. Fact is, when they're incorporated, my understanding is the reason why they incorporate is because they don't need to earn all that money to live. They don't need to declare. So what they do is the company makes that money and they draw from that company. A
salary from their number company.
Or dividend or a mix of the two. And they leave the rest in the company. But the truth is that the individual made that $350,000, $500,000. And that's the number that we should be using to qualify that individual. But if I look at just their personal tax returns and they only declared $150,000, well, there's no way they're going to buy that $1.5 million home unless there's someone and the banks have good mortgage specialists and there's good mortgage brokers out there who can navigate that and be able to explain that to the bank and say, hey, look, this is what we're dealing with.
Do you ever run into issues trying to explain that to a bank or other financial institutions?
Yeah, listen, underwriters are underwriters and brokers are brokers, and that's what we're there for. We're there to get all the pieces of the puzzle together and explain why this is a good file.
It's so interesting because you could literally everything you're saying right now and just a mortgage broker just replace with insurance broker.
Well, of course.
We're calling underwriters to try and place with the insurance companies. You're calling underwriters to try and place with the banks. It's the same.
And so excellent. So you make a good point. And it goes back to one of the first questions that you asked about cookie cutter. How many of your client files are cookie cutter?
Not as many as I would like. You know,
Those are
the ones
easy.
the ones that are not. Well, the thing is, and same thing with you. When it's easy, there's more variety. There's more options for that person. So it's typically speaking, easy come, easy go. A lot of times for clients when they have their insurance with us. If you have someone that maybe has a little bit more of a specialized case, and it's all over the place because you have substandard people have a lot of claims, payment problems, bad credit, stuff like that. And then you have another specialty market in the sense that their file, especially if their business is just a complicated business to understand, engineering, their manufacturing products, liability,
right,
stuff like that. But those clients there, once you get them as a client, number one, it's more lucrative. The margins are higher because there's a fewer supply of brokers that understand how to do that.
Right.
And I'm sure it's the same thing for like if you have a file that's more complicated to place with a bank or another financial institution, are the margins higher? It's more or less the same.
The rates are the rates unless they need to go to an alternative lender. But yeah, the low hanging fruit, anybody can do that. It doesn't take.
Yeah.
You don't need to be a specialist, or you don't need to understand mortgages that well to get an easy deal done.
Mm-hmm.
But easy deals are maybe 5%. Because most people are, someone's on mat leave. Well, what bank takes a mat leave? Oh, they're not returning for a year. Well, this bank doesn't accept that, or doesn't take this, or doesn't use family allowance, or this guy's self-employed, just start. I mean, there's so many different pieces to the puzzle today that you really have to understand a lot, and not all the banks. It's not because one bank accepts this that the other bank is going to accept it. They'll look at it this way, another bank will look at it this way.
They'll
Everybody
have different appetites.
Correct. And they have their different policies.
Is this also, would you say that one of the reasons why the banks today are perhaps more, because I can say this for sure, this is the way insurance companies are the banks more picky because they have more data to back it up with? So for example, I'll give you the analogy of an insurance company. For car insurance, I mean, there's a hell of a lot more questions that they ask today versus 30 years ago, because the insurance companies, the actuarial people that work at the company, they've aggregated all the data and they go, okay, well, based off of this and this and that, I mean, there's so many data points that they're taking now. So they know based off your file, the probability of you getting in a claim is X, therefore we're going to charge you Y premium. Are some banks collecting a lot of data points? So they're going to look at your credit. They're going to look at where you work. They're going to look at the area that you live in. They're going to look at, I have no idea what else. They're going to look at, like, I'm sure, do they?
I don't think they do. I don't think they do that yet. But you know, it's interesting you bring that up, because what I have heard is there's talk with AI coming along.
Yes.
That the banks are going to start to look a little bit more at your social media.
Oh,
no joke. Hey,
I
listen,
believe you. I believe you.
If you find out that a potential borrower loves to gamble, for example, are you going to, do the numbers say that that's a riskier client than a guy who doesn't like to gamble? I say guy, a person who gambles and a person who doesn't like to gamble. I mean, I think that's interesting. I have yet to see a bank go through what you said, at least publicly. I have not seen that, where they really just look at, you have to remember something. The banks are in business for profit.
Of course.
And now the numbers, if you look at the bank's numbers, they're lending less and less.
Yes.
And everybody wants to lend more and more, right? Like that's everybody's got objectives, the managers, the presidents, vice presidents, everybody's got to try to make their numbers. So I don't think that they're pulling back on purpose, and I don't think that they're really looking at those line items yet. But I do believe, from what I've read, slowly but surely they're going to integrate more stuff to make credit decisions than just typically right now. They look at capacity, which is your income, so capacity to repay. They look at your credit history to see, hey, does this individual pay on time or doesn't pay on time? They look at collateral. So the house is in a great neighborhood. It's worth X amount. Perfect. Character. I mean, yeah, it's kind of hard to, how do you determine character? So that's really the things that they look at. Will they start integrating more stuff, and will AI become more a part of the equation? I listen. I pose the question to you. Do you see that in your industry? Because it seems that our industries are similar in that way.
Yeah. Like the insurance companies that have the best predictive models, which are all backed by AI, are the insurance companies that are doing the best. They're making the most money because they have the most data to base their rates on.
Right.
So if you get companies like Intact, like Desjardins, like the big companies, and they're big, they're buying out other companies, and the more data you have, it's the law of averages, right?
Right.
So the more data you have, you can base it on. You're going to get better. Same thing with Google, same thing with anyone. You're going to get better at predicting outcomes than your competitors because you have more data to base it on.
For sure.
And the insurance companies just keep getting more, and I'm not offering an opinion, I'm just saying this is what they're doing. They're getting more and more granular, and they're taking more and finer data points to determine your insurance rate. And I don't see why banks wouldn't do that. And I think you're absolutely right. I'm not a fan of it. I don't think that they should be snooping around on your social media. But at the end of the day, like you said, they're there to make more money. And you're right. If I was lending money to someone and I knew that they like to gamble, I would ask a lot more questions.
I want to mitigate. Listen, they're like insurance companies are trying to mitigate their risk.
What else are banks doing right now that might be, I don't want to say controversial, that might rustle some feathers and rub people the wrong way? So besides of, I guess it's like a social credit score is kind of where it's a little bit.
Well, that's it. So let me just say, it's that's talk. I think that's the future.
Yeah.
But the future is also them scraping information out of your bank account automatic. Like instead of having let's say one of your employees comes to me to do a mortgage.
Yeah.
Instead of them having to go to HR and get a letter of employment, instead of them having to get me a pay stub, really all they need to do is
go into your bank account.
Go into the bank account, right? Do you guys do direct deposit for their pay?
Us? Yeah.
Yeah. So if I go in there as a banker, I'm going to get the client's consent, obviously. Mm-hmm. But if I go in there, I can see, oh, look, hey, Curtis employee is getting, $1,000 every 2 weeks. Boom, boom, boom. Give me something that, a T4 or something else to corroborate it. But the client is not going to have to do very much. But again, cookie cutter.
Yeah.
So
there's pros and cons. There's sometimes that I really like the convenience of having our banks, just having the big banks. Very easy to pay bills, very easy to pay your tax, very easy to... This was a little weird and I was okay with it, but I was kind of like, whoa, what the hell? So the National Bank, I didn't even get a letter. I didn't even know they did this. I owed money I know I owed money. The municipal tax, it's just the tax you get every year to the city. So I own a building. It's $4,000 a year or $3,500 a year, or whatever it is.
Yeah.
This year I got the bill in the mail.
Yeah.
So last year I never got my bill. What the hell is this? But I was with National Bank and I was paying it every, you pay your mortgage.
Yeah, with your payments.
Yeah, a part of it, they take some extra money out. So
they're managing your city taxes for you.
Exactly. But I'm the one who needs to give them the tax bill and go, hey, can you please pay for my municipal taxes, my property taxes? I never handed them the bill. I'm 100% positive, Michael. I swear to God. I never handed them the bill. And so what I'm trying to settle up with the National Bank, because the city of Montreal, they never send you receipts if it's paid or not. So you have to call them, say, hey, am I settled up on my taxes? I never got anything. Yeah, everything's settled up. What the hell? I swear to God, I did not pay for those municipal taxes, and the bank just went and paid them for me. I had a little bit of an issue with that because it's like, whoa. Like, I never said to go do that. It's my money.
Yeah, but you knew they were collecting on your behalf.
I knew that, but why are you just going ahead without my consent and just paying the tax?
No, there must have been a consent at the beginning. There must have been, because the fact that you consented to them collecting.
But why was it only the 4 years previous they didn't do that? Why not?
Listen, I used to work at the National Bank years ago.
Okay.
And I actually see, when you first start a mortgage, there's not necessarily enough money to make the tax payment in the first installment.
Yes.
This happened to me. I went to go find out how my tax account is, and it was in the negative, like $3,000. To my surprise, they were charging me an overdraft interest rate on the shortfall.
Yeah.
Now, granted, it wasn't a huge amount of money, but the interest rate on an overdraft was 20%.
Yeah.
I was like,
fuck that.
Well, wait a second.
Yeah.
No one thought of just giving me a call and say, hey, by the way, your tax account's a little light. You need to come in. Like, I would have paid it, but I must, in a year, that could have been like $500-600.
Yeah.
Anyways, I mean, I'm a fan of the managing of the taxes. Some banks are pulling away from that because it's a big job and they don't charge for it.
Yeah, exactly. It's a pain in the ass. There's a few times, and it was complicated. In hindsight, I wish I just sort of paid it myself because there's complications, and I don't think it's them being lazy. It's just it's a bank. It's a lot of moving parts. They have a lot of clients. There's shit to do, and all my buddies that worked in banks, they go, oh my God, you should see the amount of mistakes that they make on that for paying people's tax bills because they're collecting. There's a lot of that.
I now do it myself personally also.
Same.
But you got to be able to pay a couple $1,000s in one shot. Like,
well, this was my I'm naturally a skeptical guy, and this was just my logic kind of going, I go, you know what? I wouldn't be surprised if they kind of just paid without having my consent. I mean, all bets are off as soon as when they went in and froze those people's bank accounts, like back a couple of years ago, I was like, holy shit, I can't believe they just did that. And it kind of just made me think, like, okay, the Canadian consumer right now, the average Canadian isn't under a lot of stress, financial stress. And maybe the tax man came up and said, hey, give us the money before, because I feel like a lot of people aren't going to be able to afford these tax payments. Pay us right now. I could be completely wrong. That was just so
the thing is that's city tax, eh?
It is city tax.
That's different. Yeah. I don't think they have much sway over the banks. Who has sway over the banks is the federal and provincial tax guys. Mm-hmm. Now they can come and seize your accounts.
Yeah.
And that is not fun.
No.
I have had some clients come and and they stress because their mortgage payments got to go through. But if the account's seized, they're fucked. Yeah. City tax, the problem with the city tax, from a legal standpoint, it's my understanding that even if their bank has a first mortgage on the property, if your city taxes are not paid, it jeopardizes the mortgage in the sense that the city taxes get paid before the mortgage does. So that's one of the reasons the banks wanted to ensure the taxes were paid, because this way they guarantee that there's no other surprises after, right? If a guy didn't pay taxes for 2-3 years, I mean, depending on their tax bill, but I mean, everybody's tax bill has gone up tremendously over the last year, right?
Yep.
So $5,000, $6,000, $7,000 a year, didn't pay for a year or two, bank could be on the hook for $20,000 to ensure that they're protecting their mortgage.
Yeah.
But we're starting to see less and less of the tax management because it's a headache for the banks. Right?
I can imagine it is.
Yeah.
The other financial institutions, they don't do that. Like MCAP, they're not going to do
that.
They
will.
Yeah.
They'll all do it.
Okay.
But again, I think what I read recently was, I want to say TD is no longer offering that service. It's you're fend for yourself. But I really hope people budget for that, right? Because once again,
I bet you most don't.
No, I bet you most don't.
And if you have, I have an 800 square foot condo in downtown Montreal. So the property tax isn't that bad. If you go to places in the West Island, you go to places at Westmount, don't you live in Westmount?
I may. Grew up in Chambéry.
But the taxes, geez, you have a big house. It's like 20, some 15, 10, 15, 20, 25 grand after tax dollars.
Hey, listen, right here in Dollard, I'm sure the city taxes on homes are $7,000, $8,000. So if you have to make it in 2 installments, that's $4,000 an installment.
After tax.
Whereas before, if it was $700 a month, it just came out direct and it was sitting there.
Yeah.
But now, you don't have the $700. You're spending the money.
Yeah.
I got to pay for food. I got bills. Listen, it's been a tough year. We got to go on a vacation. I got to get a new car.
I want to buy that shiny new putter I keep seeing.
Oh, well, yeah. Well, in this place for sure. I saw a couple of golf bags over there.
Yeah, we have a little simulator.
I love that.
Yeah, it's fun.
Yeah. So yeah, it's going to be interesting. And they, often people don't budget for that. Even in our industry, real estate agents, mortgage brokers, we're not deducted at source for taxes. And so, when you get your commission, if it's $1,000 commission, people think, oh, I made $1,000. I'm like, well, I would suggest you take a few hundred of that and sock it away, because it's not all yours.
So if you're irresponsible, you can end up having a big tax bill at the end. Well, some people, they're just
strong word, irresponsible.
Sorry, I shouldn't say irresponsible.
No, but
they mismanage.
They're not managing it very well, and they spend all of it because they have it, and then it's like, well, wait a second. Oh, on that $1,000, I owe $250, but I didn't save the well.
That happened to one of my buddies. He's a YouTuber, and at the end, he kind of went, "What the hell?" He got a.
Does he declare that?
Yes, because a lot of it's directly paid from Google, so they'll pay you directly.
Okay. Does he make a living?
Yeah.
Nice.
Yeah, he makes a living. I keep asking him why he lives here in.
Oh, because you can do it from anywhere.
Yeah, I'm like, dude, you're a YouTuber. Go live in Florida.
Yeah, Costa Rica somewhere.
Or Puerto Rico. You don't have to pay any tax. Like, why are you?
What's he YouTubing?
No, it's my brother. So it's No, he does. I keep asking him to come on this podcast. He's a musician, so he does tutorials for instruments, music production instruments, I guess you can say. So people that want to produce music and make beats online, sell them online. Yeah, he knows how to use those instruments because there's a lot of them out there. Yeah, they're like little tools to make beats, and he'll give tutorials, put them on YouTube. And a lot of these companies, what they'll do is, because he gives good tutorials and he has an audience on YouTube, he's got 26,000 or 27,000 subscribers.
Wow.
So pretty good audience. And when these companies release new
equipment and stuff,
exactly, they'll hit him up and say, hey,
use this one, learn how to do it.
They'll send it actually to him like a month before they launch it. Say, make a tutorial for us. And then the day it launches, he'll also launch his tutorial video. And they'll kind of work together.
That's super cool. Will he review it also? Like say, hey, this is cool because it's got these kind of features and stuff?
Yeah, he does all that.
That's awesome. What does he go by? Does he have a name or?
It's Liam Killen Music. I think it's on YouTube, Liam Killen something. But yeah, you could just find Liam Killen. And
it's a good musician name.
Yeah, and I keep asking him, like, dude, why do you live in Montreal, man? I said, you're paying all this tax to live in Quebec. Jeez, go work somewhere else. He works in his house. It's like, bro.
Yeah.
Teach their own, whatever, I guess.
Costa Rica.
Yeah. The last thing here I just want to talk about, I want your opinion. Maybe you don't have much of an opinion on this. What do you think about, there's a bunch of people, there was a huge influx of real estate agents that came into the industry 2, 3, 4, 5 years ago because of the boom in the real estate economy. There was transactions going on everywhere. There were sales going on everywhere. And a bunch of them now are leaving the profession. Why do you think that is?
Oh, that is a good question. There's going to be a shakeout. I think, as we were talking before, when there was a home or a property that went up for sale during the pandemic, there was lineups, 15 offers. I mean, it was like Smarties, like it was crazy. Again, I'm not disparaging real estate agents and their work. I think what they do is valuable.
I agree.
I think they're much more knowledgeable about these things than us. Mm-hmm. But it was easier because there was just a lot of activity. Right now, what's happened is there's not very much activity. Mm-hmm. When there's not very much activity, there's not very much money being made. And those people that are already established, that already have a clientele, that are experienced, even they are going to suffer, but they'll suffer less. And those people that it was, I don't want to say easy pickings, but it was certainly, there was just so much activity that it didn't matter how good you were, there's only so much business you can do, especially because it's an individual-based business, really. Like, here at KBD, you could have 30 insurance agents working, but a real estate agent's one individual.
Yeah.
So I think there's going to be a shakeout. And the other thing I think, not unlike mortgage brokers, a lot of people do it part-time, right? Like some people they have a job, but they also do this as a sideline gig.
Personally, if I wanted to buy a house or sell my house and they said, I'm a real estate agent, and I would not want to be working with that person. That's my opinion.
Yeah, no, I listen, you ask me if I like what I do. I really do like what I do. There are days, am I stressed? Do I lose sleep at night? For sure, I do. But I do actually like what I do. I'm pretty good at it too. I like the puzzle. I'm pretty good with the puzzle and figuring out how to. Yours was not a puzzle. Yours was more just getting it to the right place and getting the right product mix. But when I think about my to-do list on every day, my everyday to-do list, there's a lot of puzzles to be made. So I enjoy that. I don't do anything else. I don't sell insurance.
Mortgage Mike. I think that's a good place where we can leave it. And anything else you want to talk about?
No, I'm glad that you guys had me. It's awesome.
Thank you so much for coming on.
Offices are great.
Thank you.
I love the playroom. Playroom's amazing.
Thank you.
I think I'm going to hang out here more.
Feel free. Come by anytime, man. So once again, this is Mr. Mortgage Mike, Michael Noik of Centura Finance. And he is a mortgage broker here in Montreal. Do you give mortgage to Ontario residents as well, or just Quebec? Anywhere across Canada?
Across Canada.
Great. So if you're looking for a mortgage, feel free to hit Mike. If you guys enjoyed the show today, Freemium Podcast, subscribe, hit that smash button for the like, send it to a friend, whatever you want to do. Help us grow the channel. And thanks for tuning in.
That's awesome.
Thanks,
Thank
Mike.
you. Thank you.
Cheers.
All right.